Hello and welcome to a special interview for The Wire supported by Glendivid Books. Do the recently released economic results suggest that the economy is reviving swiftly and smartly, or is that a misleading and mistaken conclusion? And secondly, do surveys done by the Center for Monitoring the Indian Economy suggest that India has a serious problem as far as consumer sentiment is concerned, which the government has either ignored or at least not responded to? Those are the two key issues I shall raise today with the Managing Director and CEO of the Center for Managing the Indian Economy, Mahesh Vyas. Mr. Vyas, let's start with the economic results recently announced, and after that, I will come to the consumer sentiment findings established by your organization. Now, the government is extremely pleased by the fact that in Q1, GDP grew by 20.1%, ignoring that sequentially it actually shrank by 16.9%, and it's still 9.2% below pre-pandemic levels. So taken all together, how do you view the Q1 outcome?
Well, first of all, the government and many others can take some pleasure in seeing the economy bounce back, grow by 20 point whatever percent. So it is something which is good to note, if not rejoice, that we did fall very sharply when the pandemic hit us the first time. And in spite of a second wave hitting us in this quarter, we have still grown by 20.7% or thereabouts. While that is okay, it is essentially an increase because of what we call as a base effect. The base was so bad that we had to look good in comparison to that very low base. So it could have been worse, for example, if we had not even recovered because of the base effect. So let us rejoice on that we did do well compared to a terrible last year. The problem is not in this growth rate and whether we are counting the numbers correctly, whether the base is okay or not. The problem, according to me, is the momentum, that we are not growing fast enough. This 20 point whatever percent is not fast enough. We had fallen by 24% in the quarter a year ago, and we have now grown only 20% or so. So we have not recovered from what we were before this fall. And beyond that, we need to catch up of all the lost economic prosperity that we should have seen during the years if there were to be no pandemic. So it's not just about this growth rate, base, etc. can be spoken about. What is important is loss of momentum. And I think we should focus on that loss of momentum. Before the pandemic, we were growing only at 4%, which is really very low. So any talk of going back to 7% looks a little odd to me. And I think we should focus on that momentum more than just this number.
Let's then focus on that momentum and do so by drilling a little deeper into the Q1 results. First of all, private consumption, which accounts for 56% of GDP, is still 12% below pre-pandemic levels. But even worse, it's almost exactly at the level it was in 2017, 2018, which is 4 years ago. And given that this is the biggest driver of the Indian economy, this is clearly not good news that private consumption has gone all the way back 4 years to 2017, 2018 levels.
Right. Private final consumption expenditure, as you rightly said, is about 56% of India's GDP, and therefore this matters the most. If this does not grow, the economy does not grow. So the days when we would say that India can see an export-led growth or an investments-led growth, all of that is true. And true only if private final consumption expenditure does not fail us. So it always assumed that PFCE, as we always call it in our jargon amongst economists, we can take it for a given that PFCE will keep chugging at a healthy pace. And to get that acceleration in growth, what we require is either an exports-led growth or an investments-led growth. That's what will bump our growth rate. But what has happened is that we have just seen our base get demolished. PFCE has given away. And so any talk of investments or exports is kind of hollow. So I think private final consumption expenditure needs to come up, and it's not easy for it to come up because it depends upon household incomes, depends upon jobs, and both jobs and incomes have taken a severe beating.
I'll come to income and jobs in a moment.
important.
I'll come to income and jobs in a moment's time, because those are best illustrated in terms of the findings of your own organization to do with consumption sentiment, consumer sentiment. But for now, for the sake of the audience, can I say that if what I call private consumption, the official name is private final consumption expenditure, is 12% below pre-pandemic levels, and actually it's collapsed all the way to what it was in 2017-18, i.e. 4 years ago, this is serious bad news.
That's right. It is very serious bad news. And it just raises questions. What happens to our momentum then?
Absolutely. Now, the second engine that drives the Indian economy is private investment. That accounts for 32% of GDP. But even private investment is 17% below pre-pandemic levels, and it is also lower than what it was in 2018-19. So this has gone back 3 years. Once again, this is a clear sign that investment, private investment, is not about to take off.
Private investment will not easily take off. There has been some talk in the markets about India getting into a super capex cycle once again. I think it's premature to say that. Investments will come in only when there is sufficient consumer demand. If, as we have seen, that the PFCE is down to where it was about 3 years ago, then investments is not going to pick up. Investments depends upon demand picking up, which is private final consumption expenditure doing well, and it depends upon what the unused capacity of industry is. What we call as where is the capacity utilization in industry today? According to the RBI survey, the capacity utilization is around 70% or so. Now that's a very low, which means 30% of the capacity is still available but unutilized, evidently because there isn't enough consumer demand. So if there is no consumer demand and if there is excess capacity, there can be no investments unless that investment is into long-term infrastructure development, which can only happen by the government. But till then, investments is low, will remain low till PFCE does not pick up.
Let's then come to investment by the government. This is called officially government final consumption expenditure. It accounts for 11% of GDP. It's the third driver or engine of the Indian economy. Now, no doubt, this is clearly above pre-pandemic levels, but the surprising thing is that it's 4.8% below Q1 of last year. And at a time when everyone says that there is a need to step up and increase government spending, the fact that this year is 4.8% below Q1 of last year is surely not just odd, but actually very disappointing.
It is particularly disappointing, Karan, because you see, private final consumption expenditure is all about all kinds of households, millions of households collectively saying this is not a good time to spend, and you can't possibly motivate them to come and spend. Investments is mostly about private sector investing into new capacities, and you cannot tell them, in spite of you having 30% excess capacity already, in spite of the fact that consumers are not there, still you go around investing. But government expenditure, and we should look at government expenditure, not just government final consumption expenditure, but the total government expenditure is entirely in the hands of the government. It can take a call that it can spend a lot more, and that can be the Keynesian path to spurring the economy out of its current morass. And it seems to be reluctant to do that. I think it's important to focus on this part of the GDP, which can intervene to make a difference, but apparently refuses to do so.
So in a nutshell, what you're saying, this is one area where the government, if it wants, could have intervened, could have made a difference, could have in fact pushed up demand and investment, but is not doing so. In other words, what we need the government to do, it's not doing.
That's right. I think there is almost a consensus amongst most economists, most commentators, that the government needs to bump up its spending. But even the numbers up to July of the central government tells us that the central government is unwilling to spend in spite of tax and non-tax revenues doing quite well so far. So GST collections, tax collections in general, and non-tax revenues as well, thanks to some monies coming in from the RBI. But even otherwise, government is not short of money around this time for spending, but is very reluctant to spend. And that's the curious case.
I'll underline that point. It's not that the government is short of revenue, which is what many people might think is the reason why the government isn't spending. Tax and non-tax revenues have actually increased very smartly. There have been newspaper articles and, in fact, even comments by the government itself that suggest that they've gone up far faster than the government had anticipated they would. And yet, despite the fact the government has the money to spend, it's not spending. Despite the fact there is a need for the government to spend to encourage private investment to follow, to encourage private consumption to grow, it's still not doing so. Why, we don't know, but I'm simply marking for the audience that there is a need for the government to spend. It has the money, but it's not doing so. Let me now come to individual sectors of the economy. And when we look at those that have an important impact in terms of generating employment, there are two in particular that I want to draw your attention to. The first is trade, hotels, transport, communication, and services related to broadcasting. And the second is construction. The first is 30% below pre-pandemic levels, but also 18% below the level of 2017-18. The second is 15% below pre-pandemic levels and 9% below the level of 2017-18. Both of these, in other words, are not just below and sizably below pre-pandemic levels, but they're also sizably below the position they were at 4 years ago in 2017-18. And since these are sectors that generate employment in very large numbers, this must be a worrying concern again.
That's right. Of the two sectors, one of them, trade, hotel, transport, were the ones which were directly hit by the lockdowns. So their businesses were actually shut down. You could not actually go out to have a meal, for example. You couldn't travel for a better part of the last 15 months or so. And so these were kind of shut down. This was not an economic downturn. This was actually, you shut off the engines of the sector. And you will see what you have seen, that their levels of the economic activity is something which is some 3, 4, 5 years ago. In reality, it's going to be quite serious over there. But some of these, and including construction, have seen some activities come back. They were much worse before this. And employment, and that's what you alluded to, employment suffers a lot when these sectors are shut down or they cannot perform to their best capacity. But what is worse than these sectors not being able to provide jobs is they do provide some jobs, but at lower wages. So employment is partly misleading as an indicator, because even those who are getting their jobs back after losing them are getting them at lower wage rates. So that is really very worrying, that employment is still not where it was before the pandemic levels, and wages are much worse than what they were before the pandemic times.
You're making a very important point, because I was about to come to the unemployment situation, and you're saying that although the actual figure for unemployment looks as if from time to time, not always, but from time to time, it's improving, what's hidden behind that is the quality of employment is actually sharply deteriorating. People have lost better paying jobs and are now forced to go into much lower paid jobs. And therefore, although technically they're employed, but the quality of the employment has deteriorated, and in turn, the income they earn has gone down, and that means their demand and their consumption has gone down, and therefore the impact of their employment on the economy has also diminished. In that context, let me raise something else that your organization has brought up. Actual unemployment has between the months of July and August actually gone up. It was, I believe, 6.96% in July, but by the end of August, it went up to 8.32%. So even though people are finding poor quality jobs and still struggling to carry on working, even despite that, unemployment between July and August went up, and it went up well over 1%, almost by 1.33%, 1.32.
That's right. August did see an increase in the unemployment rate, and unemployment is showing it is sticky around 7% or so. So it falls momentarily just a shade below 7%, springs back to 8%, threatens to go back to 9% or so. And it doesn't look like unemployment is coming down below 6 to 7% for sure, not below 7% easily. So the August numbers, let me tell you, although unemployment did go up, it went up because labor participation rate increased. Many more people came out looking for jobs, but the economy could not provide them jobs. And the economy shed jobs in the farming sector, in the agricultural sector. And that could be seasonal, which led to some jobs being lost. A significant number of jobs were lost in agriculture in the month of August compared to July. And the other sectors did not do too badly. Although, you can get into saying that, these are small time things. What's important over here is that employment is not picking up. We are still at around 398 million jobs compared to 410 million jobs before the pandemic hit us.
In other words, something like 12, 13 million jobs have been lost.
Yes.
Now, against the background of everything we've discussed and against the background of your analysis in particular, I want to put to you two comments made very forcefully by the chief economic advisor. First of all, he says these economic results are proof, and his exact words are, they show that a V-shaped recovery both in GDP and GVA is taking place. Do you agree that we are witnessing a V-shaped recovery?
Of course, it is a V-shaped recovery. The only problem is that the right arm of the V is not as high as the left arm of the V. So we did fall 24%, we came back 20%. The right arm of the V is way too short of the left arm. So you can call it a V, but this is not a complete V. So I think this is slightly misleading. I mean, you can choose your words, you can choose the phrases you would like to. You can, as I said earlier, celebrate the fact that we have grown by 20%. This is like a V shape, but this is not a complete recovery. So I agree with the chief economic advisor, this is a V-shaped recovery, but I'd like to complete that statement to say this is not a complete recovery.
And therefore, would it be a stunted V?
Yes, it is a stunted V, indeed.
Okay. Now, the second comment made by the chief economic advisor is that these results clearly show that by the end of this financial year, i.e. by the 31st of March 2022, the Indian economy will have grown 11%. Do you accept that? Does that look likely from these figures?
In my opinion, that's a little optimistic. And I can understand a government spokesman needs to be a little optimistic. If the government spokesman actually says things are going to be bad, it can get worse. So signaling is important, and I respect that part of the CEA's job. But I don't agree it's going to grow by 11%. I think, first of all, the markets, I must say, are broadly narrowing down to around 9% or between 8 and 9%. We believe the number will be between 7 to 8%. So the market is far from where the CEA is, and we are slightly at the lower end at 7 to 8%. So the CEA may say 11%, and it's okay, everyone has a view, but I think we are not going to grow 11% in this year.
Just to clarify, the Center for Monitoring the Indian Economy believes the economy this year will grow between 7 and 8%. That is your figure.
That's right.
Okay, at this point, I want to bring in the second subject I want to discuss with you, the surveys done by your organization, the Center for Monitoring the Indian Economy, and what they reveal about consumer sentiment. Your survey showed that at the end of August, consumer sentiment was 44% lower than March 2020. And the interesting thing is that your findings are almost identical with the RBI's current situation index. So in a very real sense, your 44% figure is corroborated by the RBI's, and I believe the RBI's figure is close to 43%. Doesn't this pose a very serious challenge to the prospects of recovery of the Indian economy?
Absolutely, and this kind of reflects in the first quarter numbers as well, as we discussed earlier, that the PFCE has performed particularly badly. And that's more or less the same as what the RBI's survey and CMIE survey tell us, that households are not happy at all. They are quite dejected, and their sentiments are 40% or 45% of what they were before the pandemic hit us. Which means if in general, households believe that the economy will function in a particular way and they will benefit in a particular way, whatever that optimism or level of understanding was, they are just 40% of that. 60% of that optimism or that perception has been shaved off. Now that's a very big fall. So anything like, 24% has recovered to 20%, there's only a 4% gap, we'll grow by 11%, we'll grow by 8%. I think all that is thin ice. We are walking or we are skating on thin ice. In reality, households are telling us that go take a walk, we don't believe all this, we are not gung-ho about the economy at all. God alone knows where you get your numbers like 8% growth and 11% growth. I'm not kidding, this is what that number means.
In fact, if you dig a little deeper into your survey results, you discover two very disturbing facts. The first is an explanation for why consumer sentiment is 44% lower than what it was in March 2020. Your survey reveals that average household income in real terms during the last year diminished or shrank by 20%. That is why consumer sentiment is so low at the moment, because households are poorer, they don't have the money to spend, they've lost confidence in their future, and therefore their sentiment has collapsed. And the first explanation is that average household income fell by 20% in real terms, which is a huge fall during the last year.
That's right. So there are several questions that the CMI survey, the Consumer Pyramids Household Survey, asks households. It's a very large survey. It's 175,000 households and more. And collectively, these people told us in the financial year 2019-20, their incomes, their average incomes, declined 14.9%, nearly 15%. And you add on top of that inflation, consumer price index inflation that we have seen in the same year is over 6%. Add these two, and the real hit that households have seen in terms of their ability to buy goods is over 20% shrinking. That's a very big hit. Anyone who sees his or her nominal income go down will be very reticent to go out and spend. And if you see a real reduction in income, you will be really very scared of the future. And that's exactly what the consumer sentiments are telling us, both the RBI survey and the CMI survey, that incomes have really shrunk. Now, one part is I asked directly of your income. We actually count things like how much did you earn from wages, how much from dividends, how much from interest, how much from pensions, how much from remittances, how much from government transfers, how much from profits from business. Everything put together tells us that there's a real terms 20% or more decline. Separately, we asked them, is your income this year around now lower than a year ago, or worse than a year ago, or the same? And both these pieces of information asked independently tell us the same thing. Households are severely hit.
Now, the second thing that's revealed when one digs deeper into your survey results is not to do with what happened over the last year, which is past, is to do with how people anticipate and what they expect will happen over the next 12 months. And this is equally worrying because your survey shows that 41.5% of households believe that their incomes will worsen over the next 12 months. In other words, their incomes won't grow, they will shrink over the next year. And add to that the fact that another 50% do not expect their incomes to improve at all. Taken together, this means that the vast majority of households actually will have no inclination to spend. Therefore, there will be no boost to demand, and therefore there will be no ripple effect on investment production and growth. This is equally worrying because it means that there is no immediate pickup happening in terms of income and therefore in terms of personal consumption and demand.
That's right. The lessons from here are very clear, and we need to take cognizance of this, and the government needs to take cognizance of this, that there is deep despondency in the household sector. It's not just the CMIE survey saying this. It is also the RBI survey saying this. So in case they have a problem with some private agency putting out negative numbers, this is not something which is only a private sector negativity showing up. This is actually the situation one needs to take cognizance of and take initiatives to repair this. This will not get repaired by itself. The markets cannot solve this. If you wait for the markets, we will wait for far too long. And the impact of that and the cost of that in terms of children's education, in terms of health services, in terms of people being vulnerable to become more poor or fall below the poverty line, all these are big risks we carry if you don't pay attention to the deep despondency in the household sectors, to the fall in incomes, and to the negativity that households are telling us that they don't have hopes regarding the future.
Let me underline something that you said. This is not just the CMIE surveys that are saying that households are in deep despondency. The RBI's own current situation index says exactly the same thing. So the government can't turn around and say this is just a private sector think tank that's saying it. The government's own RBI is giving them the same indication. Now, let me draw three sets of separate conclusions from our discussion because we're coming to the end. Would it be right to say that private consumption, which is 56% of GDP and is the biggest engine driving our GDP growth, private consumption was already 12% below pre-pandemic levels. In fact, it's collapsed to the level it was at 2017, 2018, i.e. 4 years ago. That private consumption doesn't look as though it's going to substantially increase or even increase at all. Because if households believe that incomes are going to worsen or not improve, they're not going to spend, and therefore private consumption won't go up. And that means 56% of the Indian economy will be underperforming over the next 12 months.
Yes, but I wouldn't drive this too hard, Karan. I would be a little more careful on that, because a large part of India's growth in value terms comes from a top sliver of the Indian economy, of households, the richer households. They have savings to fall back upon. They are the ones who are buying cars. They are the ones who are buying high value consumer durables, and they have the savings. And if their sentiments flip tomorrow, they can start spending, and that can reduce the impact of what we are seeing today.
Okay.
Consumer sentiments, sorry, just 1 minute. Consumer sentiments is very important. You have money, but you don't spend if your sentiments are bad. But if your sentiments turn good, you already have money with you and you can start spending. So one needs to watch out for the index going forward.
That's very true. There's a small sliver of the well-off who can spend in adequate numbers and in adequate quantity to give growth, but their sentiment needs to flip for that to happen. That flipping or turning of their sentiment hasn't happened. Is that it may? If it does, you will see personal consumption improve, you will see growth, but it all depends on that. But the vast majority of the Indian population are not in that small slither. The vast majority urgently need income support from the government. Not just because it would make good economic sense, but also because it's a humanitarian concern. They are poor, they are losing money, some of them may be hungry. That is something the government isn't doing. What do you make of that? These are people who need income support. All over the world, the governments have given income support. Ours did it in a very thin, fledgling way initially, but it hasn't done it thereafter. What do you make of that?
I think that's the biggest enigma of our times. I don't understand. I don't think anybody understands outside the small core within the government, I think. Why is the government steadily so reticent in spending money, in intervening to help households overcome their current difficulties? Why is the government not applying itself to this problem? Why repeatedly it seems to address the problems of the supply side by providing liquidity support at a time when economic conditions are bad? Nobody wants to borrow or increase leverage. What they want is more markets to open up for them to sell. That's not happening. Nobody is buying. They want more incomes, but nobody is giving them incomes. So giving liquidity support and debottlenecking liquidity support and supply side problems or solutions are not solutions. The problem is on the demand side, and the government's steadfast refusal to accept that, I think, remains a mystery, and we can leave it there.
Two other quick questions. The one thing the government is required to do, i.e. income intervention and income support, is the one thing the government is not doing. That follows from what you're saying, doesn't it?
Yes. It may say it doesn't know how to do it, but that's defeatist. It doesn't matter if it is not perfect, but the perfect solution does not have to be the enemy of a good solution.
One other conclusion. To what extent will the government's failure to provide income support actually hold up economic recovery? And if that is the case, that it will hold up economic recovery, isn't the government to that extent alone to blame?
That's a little complex question, but the simple answer to that is yes. But the government can take credit for many things it does. For example, the government is targeting help to the very poor. For example, there are fund transfers that happen to the very poor. There is more spending on Manrega since last year. There is some food transfer that happens. So the government seems to be intervening at the very poor level by doing direct interventions over there. But that's not a solution to the economy. The economy requires a macroeconomic approach to say that aggregate demand needs to come up. Otherwise, we will forever keep feeding the poor because the poor don't have other avenues of getting income. So this is digging your own grave by only doing targeted interventions to the very poor people in only select areas.
In other words, and this follows, I presume, from what you're saying, if the government doesn't take the sort of steps necessary to boost aggregate demand, we will not reach the levels of growth India requires. Leave aside double-digit growth, we may continue to struggle at 4, 5, and 6% growth. 6 would actually be very good. We may continue to struggle at 4 and 5. And that would be put down to the government's inexplicable reluctance.
I think we can say that, yes.
Thank you very much indeed, Mahesh Vyas. This has been particularly illuminating because I think you've helped the audience understand that the extent, sometimes some would say gleeful pleasure that the government has taken at the fact that the economy in Q1 grew by 20.1% is not entirely correct. It's possibly misleading because it overlooks the fact that sequentially the economy shrank by almost 17%, and in terms of pre-pandemic levels, it's still 9.2% below. But even more important is what has happened to personal consumption. It's fallen all the way back 4 years to where it was in 2017-18. And your surveys suggest that it's unlikely to pick up over the next 12 months. And since personal consumption is 56% of GDP and the biggest engine driving our economy, that is not good news. And the government needs to intervene. It needs to give income support to boost aggregate demand, and its reluctance to do so is inexplicable. That is a picture that the government doesn't give us, but you helped us understand, and I thank you for it. Take care, stay safe.
Thank you.